Okay, can everyone hear me okay?
Yes.
All right. If I do drop out, get my cell phone, which is on this next screen. All right. So we'll start. Property and casualty exam prep course. Like I said, I'm going to rotate between webinar and actually having a live class over here in Emeryville. I know some people can't make it. I got some people from Southern Cal jumping on. Some of you in the Modesto area. But I mean, I'll rotate it. So now, the webinars are free, not a problem. I'll keep this available, make this available for anyone who's interested. But it's probably not enough to get you to pass a test. So if you haven't already registered, some of you already have access to my sample test questions online. I recommend that you go through that. If you haven't registered, for most companies, it's only $50 to have unlimited access. So here's the instructions. Go to the website, click on programs and pricing. There's a PayPal link next to the course that you want. I have life and health, property and casualty. I have some companies that just want the life only. And I also have adjusters that also have exam material for insurance adjusters and public insurance adjusters. So if you're already with a company, I do have a couple discounts for certain companies. And you look for the company, click on that link, and then there's a PayPal link with the discount price. So, but if you do have any questions, this is my cell phone number. You can call me. As you're studying, I encourage you to call me if you have questions. I don't want you to Google terms, check Wikipedia on definitions, because it'll give you a general definition, and it's not going to look the same as the definition you actually see on your exam. So don't hesitate to reach out to me. If you text me a question, because it's my cell phone, expect me to call you back, because I'm not going to text 3 paragraphs. Okay. But it's okay to text me questions, and then I'll probably, expect me to, give you a call back as soon as I'm capable or able to help explain it. Right? Or you can email me, Lauren at lgdconsulting.com, with any questions you may have. Probably give me the, which exam you're working on, which question number you're having problems with. And then if you do email me, I can just reply with the explanation and go from there. So, and during this whole program tonight, as we go through it, we'll hold questions till the end. But if you do have a question, just pop in. But if not, we'll hold it to the end. So my recommendation is write the slide number as far as which one you have a question on, and we'll go through it, and then we can go back to that slide at the end of the presentation. I can help explain, what I have and why I have it laid out that way. Okay. So about the exam, fire and casualty exam, it's 150 questions. You're probably going to get 155 to 160. So they throw in 5 to 10 additional questions that do not count. The problem is you don't know which ones those are. So you want to do your best on all 155, 160, whatever they give you. The 150 that you are graded upon, you need 60% to pass, and by most standards, that's a D. This is a tough D. So I got to tell you, don't take it personally. I mean, I've seen people crying, because they don't pass. Oh, I couldn't even get a D. I've met people that failed it 3, 4 times. Okay, this has nothing to do with you, unless you didn't study. Then I can't vouch for that. But for the most part, don't knock yourself. Okay, this is not an easy D. Okay. The questions and the verbiage are not what you're used to, whether you've done exam effects, pre-licensing training, Lightspeed, or any of the other online training programs. Their questions and the questions you'll see on your exam are not the same. All right. So the test is set up for a 50% pass ratio. That means most people that do fail, they fail at around the 50% level. And I ask them what their weak spot is, and there really is no weak spot. If you look at their scores, they're 50% in all 4 categories on this test. And that's what the test is designed for people to do. Okay, just so you know. You do have 3 hours to complete this exam. 3 hours is a hell of a long time. It's about 1 minute and 20 seconds per question, which is a long time. If it takes you the full 3 hours, you probably didn't study well. Okay. Most people are done about 1.5 to 2 hours max in most cases. But fear not. It's not a race. You don't have to be the first one done, but don't be afraid to be the first one done. So if you're punching through this thing and you feel pretty confident to go through it, and you're done with it, but you don't want to be the first one done, it's okay to be the first one done. Okay, when I take my exams, I'm always the first one done. So don't think, well, I don't want to be the first one done, because then you might want to go through the whole test all over again, and then you change the right answers to wrong answers because you're kind of tired now and you second guess yourself. And don't stick with your initial instinct. It sounded right, sounded familiar. That's what you want to go with. Okay. So let's look at the title of this course and this exam you're going to take. It's the property and casualty or the fire and casualty exam. Now, property and fire are interchangeable. Property loss is the same as a fire loss. And that basically, property and fire coverage covers your stuff. That would be your house, your car, your business. So in a contract, that would be you and yours. All right. You are the first party to the contract. You're the insured. All right. You're buying a policy, you're paying premium to an insurance company. The insurance company is the second party. The insurance company is going to be we or us. So in a contract insurance policy, we or us, the insurance company, are going to cover you and your stuff in the event of a loss. All right. Now, that's for property.
I can't.
What's that?
Oh, the audio had went out and just came back. That's fine.
Oh, okay. This happened yesterday too. Okay, or the other night. All right. Yeah, just let me know if it goes out. All right. Okay. So property, we are us, the insurance company, which is a second party, are going to cover you and your stuff because you're the first party. But if you have liability, we or us are going to cover you in case you injure them or their stuff. And so casualty protects against a number of occurrences. Liability makes up the biggest area of casualty coverage, and that would be someone else. Like, let's say you lost control and you drove through someone's living room because you lost control in the rain. So you damage their property. That would be their house, or maybe you hit their car, or even if you injure them. All right. And so that would be liability or casualty coverage. So always think third party. And I always say, whenever I see L for liability, I think L for lawsuit. All right. So you damage or injure someone else, and they're going to sue you to pay for it. That's what that's about. So think liability, right? So again, we or us, a company, are going to cover you and your stuff, but we're also going to protect you in case you injure them and their stuff. Okay. All right. So we'll go through a couple of questions here and there, but let's go through a little more terminology. The biggest thing, you will get questions like on insurance. All right. And so I don't know what definition you're going to get on this. One of the questions may say insurance is defined as which of the following, and it's a one-word definition. It says contract. Okay, so insurance is a contract. Great. It may say insurance is a contract to indemnify. Okay, that's great. So, because that's a true statement also. Or it may give you the full definition. Insurance is a contract to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. Okay, I don't know which question you're going to get, but you do need to know those answers. Could be the one-word definition contract, could be the full-fledged definition. It's California Insurance Code Section 22. You typically do not need to know code numbers. You might see California Insurance Code Section 22, but it won't just tell you what is California Insurance Code Section 22. All right, it'll be part of the question though. California Insurance Code Section 22 defines insurance as which of the following, and then you need to pick one of the answers. So it is a contract of indemnity. So that's the next one. Indemnity means to restore you to the condition that you had prior to a loss. So if you had a 3-bedroom, 2-bath house, then it got destroyed by a fire, if you have the proper homeowner's policy, we're going to cover the cost to rebuild the exact same 3-bedroom, 2-bath house that you had before the fire. Okay. We're not going to build you a 5-bedroom, 3.5-bath house because that was a gain. That improved your condition, and that is not what insurance is about. Okay. So always remember, indemnity means to restore you to what you had before the loss. In order to buy insurance, the third item here, you have to have what's called insurable interest. Now, insurable interest is defined on your test as having a legitimate economic or financial interest in the preservation of the life of the property that is the subject of the insurance. I mean, that's a lot, and I don't think you're going to remember all that, okay? But get the concept down. Insurable interest means in order for you to insure something or somebody, if that something or somebody were to suffer a loss, financially, you're going to be affected. So what that means is you can insure your house because if your house were to burn down, it will cost you money to rebuild it. All right. If you damage your car, you can insure your car because if you did damage your car, it will cost you money to fix it. But you could not insure your neighbor's house. See, if your neighbor's house burns down, financially, you're not affected. Emotionally, you might be distraught because they were like really, really cool neighbors, but financially, there's no effect for you. And if there's no financial effect, then you don't have insurable interest. In the property and casualty field, you do have to prove insurable interest 2 times. Number one, when you purchase the insurance, okay, which the test will say sometimes at the date of application. And number 2, at the time of the loss or at the time of the claim. All right? You also have to prove it then in order to collect. All right? So always remember, for property and casualty, you have to prove insurable interest twice, when you purchase insurance and when the loss occurs. Okay. Risk is defined as uncertainty of a loss. So just look for the word uncertainty. Loss is a reduction in the quantity, quality, or value of an asset. Okay. The loss doesn't have to be great. I mean, a dent in your fender should not bankrupt you, but financially it'll cost money to fix it. If you don't fix it and you were to sell the car, you'll probably get less than what you thought you would because they'll point out the big dent in the side. Okay. So there is, again, a financial attachment in the insurance world. All right. Peril, put a star on that one. Peril is defined as a cause of a loss. Okay. Fire, explosion, flood, cancer, AIDS, those are common perils. They cause loss. All right. And again, as far as perils, we're going to dive into it. You have named peril forms and you have all risk forms. So a named peril form would be like a standard fire policy. The standard fire policy, even though we don't sell it anymore, you're probably going to get it on the test. It's a policy that it only covered 3 perils: fire, lightning, and a situation called removal. All right. So those perils are covered. So if something happens to the property and it's not one of those 3 perils, it won't be covered. So it's an extremely limited policy. All right. Fire, lightning, and a situation called removal. Okay. Removal, like I said, is more of a situation. Let me give you an example. Your house is on fire. The first thing you should do is probably get out with your family. Okay. Then you're going to call 911. And then what some people would do is they run inside, remove some of the stuff from the burning building and put it in the driveway or the neighbor's yard to protect it from further loss. Okay. And then they run in for some more stuff. Now, when they run out with some stuff, put it down, they run back in. Let's say people are stealing it. I know, well, that's got to suck. Your house is on fire. You're taking stuff out and protecting. As you're bringing stuff out, people just grab it and running away with it. So now theft is not a covered peril because the policy only covers fire, lightning, removal. But during removal, you have what's called all risk coverage. So the unavoidable theft during removal would actually be covered, even though the policy typically wouldn't cover theft by itself. Okay, so it's more of a unique situation. And we'll cover that a little farther down the road, but that's a peril. So the policy, the perils, the policy lists perils we cover, or it's going to list exclusions, which are perils we don't cover. All right. A hazard is a condition that would increase the likelihood of a loss occurring. There's different types of hazards. I'm going to start with a physical hazard, so arising out of something structural, something tangible. You know, living next to an explosives factory is an example of a physical hazard. That was actually a test question. Someone with badly worn tires, again, that's a physical hazard. Physical means you can reach out and touch it. All right. Now, there's other types of hazards, moral and morale. Now, moral ends with an L, M-O-R-A-L. L, whenever you see the L at the end of it, think of L for lying. Okay. Yeah, welcome to the world of auto insurance. We're even going to tell people, hey, we're going to look it up, but you still got to ask them, have you had any tickets or accidents in the past 3 years? And people will lie to your face. All right. No. And so then you look them up and you realize they've got like 4 tickets in the past 8 months. Okay. I mean, they lied to you. You're still going to write them. They just got to pay a higher premium because of their experience. Okay. So moral is where someone has a tendency to lie, cheat, be dishonest. Now, morale hazard, M-O-R-A-L-E, arises out of carelessness. Your test will say they have an indifferent attitude. So think of someone who drives fast, engages in high-risk hobbies like skydiving, scuba diving, and things like that. They're putting their own life at risk, which means they're more likely to suffer losses. Okay, that's a moral hazard. I always break it down to more ale. You know, when you drink more beer, you get careless and clumsy. Okay, that would be a morale hazard versus a moral hazard. So you got to know the difference between the two. Very common test questions. The fourth type of hazard is a legal hazard. Legal hazard is a person that's going for more money than they're legally entitled to. All right. I mean, someone who just got hit, it's 5 mile an hour stop and go traffic. They got bumped, and now they're claiming, suing for $2 million, claiming soft tissue damage. Okay. I mean, there's not even a scuff on the bumper to show that they got hit, and they're trying to get $2 million out of this. All right. And that does happen. All right. And so, but it's a type of hazard. Now, even though the insurance companies may choose to defend you or maybe offer a settlement to let that claim go away, they had to pay money out for that. And so, therefore, the hazards cost the insurance company more money, which also, by the way, causes us policyholders more premium. Okay. But a hazard is like a catalyst to a peril. All right. Now, parts of a contract, we have agreement. Agreement is broken down into offer and acceptance. So for those of you that are registered on my website, I have a playbook on the website, and it has these definitions on there, but these ones I definitely want to explain to you, okay? Because on this test, you're going to have contract law terminology, which even though you probably won't use it when you're out there selling insurance, you got to know it for the test. So agreement is broken down into offer and acceptance. You, the agent, are going to offer to sell insurance to the public, and they need to accept it. Yeah, you're right, I need insurance. So they're going to accept your offer, and then they're going to fill out the application and pay premium back to you to give to your company. And so this is kind of a counteroffer. Here's the information you requested. Can you insure me at what you put in your proposal? And so the insurance company underwriter gathers this information. They underwrite it and say, oh, now because you have these tickets, we can still write you, but we have to charge you higher premium. So here's another possible counteroffer back to the client. All right. Now, and then the client says, well, I need the coverage, in order to drive my vehicle on the street. So I'll go ahead and pay the increased premium to have the coverage. So it doesn't matter who makes the offer. Both parties have to agree to the conditions. That's when we have agreement. Consideration is an exchange of value. Clients actually give two things of value. They're going to pay premium, of course. Money is always valuable. But they're also going to provide some personal information about themselves on the application. So it's premium and information is what the clients give as far as value. But the company has to give something of value back. And the insurance company gives what's called a promise. We promise to pay should you suffer loss according to the terms of our contract. That's what consideration is in insurance. It's an act, filling out the application, paying the premium for the promise of receiving benefits. Okay. In selling insurance, you got to deal with competent parties. That's people in their right mind. And use your best judgment. Your company's hired you for a reason. They trust who you are and how you are when you're dealing with the public. So if someone doesn't seem like they're all there, back away, bow out gracefully from the sale. All right. It's your agency, it's your business. You can choose who you want to work with, and if they don't seem like they're all there, then don't write them. Okay. So let's kind of define that. Number one, they cannot be a minor. Minor means, they legally cannot enter into a contract. And for the test, age 16. 16, you can actually enter into a contract. Age 15 is a minor, I should say. Let me clarify that. Because you can get a learner's permit, and then you can start driving, get a driver's license at age 16. But in order to drive, you got to have insurance. So you can buy insurance when you're 16. It's kind of funny. You just can't sell it till you're 18. Okay? So they got to be a legal age. Number one. Number two, they cannot be under the influence of alcohol or drugs because they're judgment impaired. All right? That's what that's about. Okay. is you got to be mentally competent, use your best judgment. And it's a weird one, but every once in a while people got a question that says they cannot be a public enemy. A public enemy is someone who is armed and dangerous and wanted by the law. Well, we cannot insure them, okay, especially for life insurance, okay? So, yeah, they're a public enemy. You sell them a life policy. The police shoot and kill them as they try and bring them in, and that person's family members made money from the life insurance you sold them. Yeah, that's kind of a conflict, okay? So, legal purpose. You purchase insurance to protect against a loss, but another way of saying that is it means you cannot get a gain. All right, so legal purpose means you're protecting against a loss, which also means you cannot get a gain. See, there's two ways of saying the same thing. And that's how this test is pretty tricky. Let's say you have a red pen. This is a red pen, this is a red pen, this is a red pen. And that's what you learn in your training. This is a red pen, this is a red pen. And then when you go take the test, it doesn't say this is a red pen. It says this is not a green car. Well, this is not a green car is the same as saying this is a red pen. It's just two ways of saying the same thing. All right. And so on your online training, they kind of condition you to know this topic one way. And then you take the test and they ask the question or that topic from a different angle and you don't recognize it. Okay, so be wary of that. Go through the sample test questions, be thorough in your studying and going through all my questions on my website. Okay, so who is considered the first party to an insurance contract? That's the insured. That's the client buying the insurance. All right, so the second party to the insurance contract is the insurance company. These are some sample test questions you may actually get on your exam. So, now that we covered it, it makes it a lot easier. All right. In a commercial property policy, the company providing the insurance is referred to as, and like I said, we or us are going to cover you and your stuff. That's how you need to understand that. All right. Now, it's kind of weird. It's like, this is simple. And, it's kind of weird you have these questions that really don't help you sell insurance. But that's the test. So you got to get through this stuff. All of this is short-term memory. The longer you wait to take your test, the more you actually forget and retain. So my recommendation is just designate some time, sit down, study, knock out this test, and be done with it within the next week to 2 weeks. Okay. Again, the longer you wait, the more you forget. All right. So which of the following best characterizes a speculative risk? And I'm going to leave this open to you folks to try and give it a shot. Nobody's unmuting and going after it, huh? All right. I see how it is. It's like me talking to myself at home. No, I'm kidding. All right. Speculative risk, think of gambling. It's a possibility of loss or gain. This is a type of risk that we don't insure. Because in insurance, if you can get a gain, we're not going to write the policy. So if it's a 3-bedroom, 2-bath house, okay, we're going to cover the cost to rebuild it to the exact same 3-bedroom, 2-bath house it was before the fire. That covered the loss. We're not going to build you a 5-bedroom, 3.5-bath house with a sun deck, cupola, jacuzzi, some skylights that you did not have before the fire. Because that was a gain that improved your condition, and that's not what insurance is about. Okay? All right. So what is the type of loss exposure that would include land and property attached to it? This one's kind of a tricky question. We never insure land with property insurance. All right? So you can only insure liability exposure in relationship to land. Okay. See, if you have a house, we're going to cover the cost to rebuild your house. But if your house burns down, if you take a good look, you'll notice the land that it was sitting on is still there. Okay. You never insure land as far as property. However, you could have a party, someone could slip and fall on your land, and since you own it, they might want to come after you to pay for their injuries. And so there's a liability exposure associated with land, but you cannot insure land with property coverage. Okay. Which of the following types of loss would result in a claim for monetary damages due to injury to another or damage to another's property? And since you injure someone else, that's going to be liability. Right, keep that in mind. Remember, property is you and your stuff. Liability is them or their stuff. Okay? The possibility of financial loss resulting from the ownership of property is known as, and that's insurable interest. Okay? Remember, insurable interest is having a legitimate financial or economic interest in whatever you're insuring. That means in order for you to insure something or somebody, financially you have to be affected. Otherwise, you can't buy a policy. If you did buy a policy, the companies will limit what you can collect. Okay. These next three questions, you're going to get 2, possibly 3 of these next ones. So which type of exposure can best be defined as a condition or situation for any exposure or financial loss which is presented to an individual or family by such causes like injury, disability, death, or sickness? And if it's family, that's going to be a personal loss. All right? Now the question may change to which of the following is also known as a human loss. And a human loss is still going to be personal. Think of family. All right? Now, if they switch the question to this one, which type of loss is a business exposed to death, retirement, resignation, or disability of a key employee? Well, that's going to be personnel. Okay, so personal, think of family or human, and then personnel, think of work like an employee. Okay? And again, you'll probably get 2, if not all 3 of these questions on your test. They are very common. Okay? Where do insurers get their policy forms from? The insurance services offices. So your insurance companies get the forms from the ISO. They're going to personalize it, put their company name on it, change some of the provisions and stuff, and then they're going to file it with the Department of Insurance. So keep that in mind. Your companies get their policy forms from the ISO, they personalize them, and then they now have to send them to the Department of Insurance for approval to use. Okay. So we're going to jump into personal auto coverage. The first section is going to be liability, which is coverage A. All right, this is something you'll actually use in the real world also. All right. In California, we use split limits. So we're going to break this down. So the common split limits, the minimum liability to register your car is $15,000, $30,000, and $5,000. Now what this means is we pay $15,000 for bodily injury per person, $30,000 for bodily injury for all persons in the other car that you injured, because remember, liability covers them, and we're going to give them up to $5,000 towards the damage you did to their car. Now, it may not be a car. Like I said, it's raining, you lose control and drive through someone's living room. With this policy, you only have $5,000 to cover the cost of rebuilding their living room. Okay, probably not enough, but this is the minimum liability limits to register your vehicle in California. Okay. So if you hit a car with 2 people in it, okay, we're going to pay a maximum $15,000 per any one person in the other car. And so if you hit a person with, 2 people, the first person had, 12,000 medical bills, and the second one had 22,000. Well, we pay 12,000 for the first person because that's less than 15, but we only pay 15 for the second person because 22,000 is more than 15, and we have a limit of 15 per person. So 15 plus 27, or I'm sorry, 15 plus 12 equals 27. 27 is less than the 30,000, so we pay the 27. Okay, so you want to resolve the per person limit first, and then go into add them all up, and then the per occurrence limit will be the maximum we pay for everyone injured in that accident that you caused. All right. Now, liability covers the other people in the other car. What about you and your family members or friends in your car? Well, that's what medical's for. And so if you have 2,000 medical, this is a per person limit. We don't have a per occurrence limit for medical. So if you have a 12-passenger van and all the seats are full because you're taking the kids to a Girl Scout meeting and they're all injured in an accident you caused, each of them will get $2,000 towards their medical bills. Okay, so it's not a per accident limit, it's just a per person limit. Coverage C is uninsured motorist. This is the only liability coverage that actually pays you because you got hit by someone who doesn't have insurance and it's their fault. So that's uninsured motorist. Okay. Notice there is only 2 numbers because uninsured motorist only covers the people, you and your family in your car, and your friends in your car, by the way, that are injured because of someone else who didn't have insurance. They got to meet the definition of uninsured motorist. It's real simple. Someone who doesn't have insurance, someone who says they have insurance, but their insurance company went bankrupt. That means there's no coverage. Someone who says they have insurance, but the company denies the claim or denies the coverage, I should say. That means someone bought insurance to register the car. They stopped paying premiums, but they left that little evidence of insurance card in their glove box. They hit you, they show you the card, you gather all the information, you call the insurance company, and they say, oh, no, they're not a policyholder anymore. Okay, so that would chalk up as uninsured motorist. Okay, or a hit and run driver. Hit and run, we say that they didn't have insurance because the reason they ran is they probably didn't have insurance, because if they had insurance, they would have stopped and let the insurance company take care of it. Okay, that's uninsured motorist. Now, again, uninsured motorist, there's only two numbers because it only covers people. All right. Now, underinsured motorist is you got hit by someone who actually has insurance. They just don't have enough to take care of you and your family. And so this can actually make up the difference between their insurance and what it still costs to protect you and your family and cover your medical bills. All right. Now, remember, this is only the people. To cover your car, hopefully you had uninsured motorist property damage. Now, if you only have the liability coverages, which is A, B, and C, you don't have collision, the maximum we're going to pay to fix your car because someone without insurance hit you and it's their fault is $3,500. And this number will look familiar on your exam. It's a very common test question. Okay. So California has lower financial responsibility limits than most other states. If Randy, a California personal auto policy insured carrying minimum limits on coverage, has an accident in this state that requires higher limits, then the policy automatically provides higher limits for no additional charge. Let's say you had 1530 in California, you drink too much Red Bull, and you wake up in Alaska and you get into an accident. Alaska's liability is 5,100, but you only bought 15,000, 30,000. Very low limits. But as long as you're just visiting Alaska, you'll automatically be provided with the 5,100 while you're visiting Alaska. Now, it's just a visit. If you actually move to Alaska, typically within 20 days, you register the car and you need to get the proper coverage. Okay. So automobile limits of liability are expressed as 25, 50, and 10. This would mean, and this is a common test question, the numbers may change, but the concept doesn't. We're going to pay $25,000 bodily injury per each person, $50,000 for bodily injury for everyone in the accident that you injured, and $10,000 for property damage. Okay. All right. So that's liability. Now let's get into the physical damage part. It's broken down into two parts: collision and other than collision. Now, for those of you that have some real-world experience, we usually call it collision and comprehensive. Well, the test doesn't call it comprehensive, it calls it other than collision. So keep it real simple. Collision is you hit something, it's your fault, and you damaged your car. Okay, so physical damage, this is now covering your car. So collision, it's your fault, you damaged your car because you hit something like a tree. Now, other than collision is something hits you. That means in a storm, the tree fell over and hit your car. So that's other than collision. It's not your fault. Collision is your fault, higher deductible typically. Your rates are going to go up because it's your fault. Other than collision, it's not your fault, lower deductible. Your rates won't go up because it's not your fault. Okay? If someone steals your car, that's an other than collision claim. All right? How about if you hit an animal on the road? Would that be collision or other than collision? Nobody wants to jump in, huh? Okay. It's going to be other than collision because we always say the animal hit you. So keep that in mind. Anytime you hit a deer, a dog, or a cow on the freeway, we always say the animal hit you, so it's an other than collision claim. Again, lower deductible. It's not your fault. Your rates don't go up. Okay. Now, if you lock your keys in your car and you break your window to get your keys out, that will not be covered. Even though it's damage to your car, it was intentionally caused by you. So intentional acts and wear and tear are not covered by insurance, folks. Keep that in mind. Okay. Someone steals your car, that's other than collision. Hail, you get caught in a hailstorm and the hail drops and dings up your car. The hail hits your car, that's an other than collision claim. Okay. And so things like that you need to understand. Now, when you have physical damage, some optional coverages, did you need a rental car? For the test, if you do get the rental car coverage, we'll pay you $20 a day for a rental car. And $20 a day is not a whole lot for a rental car, but that's for the test. Okay. Now, if you do get into an accident, you typically have to wait 24 hours before we pay you $20 a day for the rental car. If someone steals your car, you got to wait 48 hours or 2 days before we pay you $20 a day for the rental car. Reason is if someone stole your car, we give you 2 days because it might show up, number one. Number two, you sober up and remember where you parked, because that does happen also. People forget where they park, okay? And so we give it 2 days before we pay you $20 a day for the rental car. Another optional coverage is towing and roadside assistance. This is a tow truck coming out to your car and towing you to the nearest repair shop, or giving you a jump start, fixing a flat, or unlocking your car because you lock your keys in the car. That's what towing roadside assistance is all about. Okay, so it doesn't cover the actual repairs on your car at the repair shop. It just covers the tow to the repair shop. All right. So damage done by an earthquake to an insured auto is covered by the personal auto policy, and that is if you have other than collision. Okay. And this is kind of a weird test question, but your policy, your auto policy, actually covers flood and earthquake loss if you have other than collision coverage. Okay. Reason is your car is sitting in the field, sitting in the middle of the field, and there's an earthquake that rumbles through, which causes the ground to shake. What damage could possibly happen to your car? Nothing. That's why if you have other than collision, it's going to be covered. Now, if you're in downtown San Francisco and there's an earthquake and a building collapses and falls on your car, well, that would be an other than collision claim anyway, because the building hit your car. You didn't drive into the building hit you. Pay your deductible. It's other than collision claim. Your car's fixed or replaced. Okay. All of the following are factors for rating for physical damage coverage on a personal auto policy, except. Watch out for the excepts. You do get a lot of them. The test will give you a bunch of double negative questions. All of the following are incorrect, except. A lot of the test isn't really testing you on the material. It's just making sure you can read the question correctly. Right? So all of the following are factors for rating physical damage, except. Well, physical damage means I need to know what kind of car you have. Therefore, your driving safety record is not a factor for physical damage. It is a factor for rating you for liability, but it's not a factor in rating you for your physical damage part of your policy. I just need to know what type of car you drive. All right. Under a personal auto policy, which of the following is not a collision loss? Okay, so which is not a collision loss, it means something hit me. And that would be the animal. That's not a collision claim. That's an other than collision claim. All right, that's what that's about. So, okay. Okay. Let me see. Have this muted on your end. That's why. Oh, I'm sorry. I'm just noticing you have a question up here, so I apologize. So, yeah, let me have it. Let me unmute it. Sorry. All right. So I'm going to unmute everybody. So I've only got 4 people online, so don't hesitate to jump in. I apologize. Didn't realize that. Okay. Okay. And let's continue here. All right. Rating factors for liability. It's based on Proposition 103. Now, you might see Proposition 103. You might see the Unruh Act. Again, there's 2 ways of saying the same thing. A lot of people in your online studies, all you see is Proposition 103, Prop 103, and then you take the test, and it basically calls it the Unruh Act, and you're like, what the hell is that? Okay, it's the same thing. So for rating liability, I need to know a little bit about you. So the most important factor in rating you for liability is your driving safety record. Okay, and that's a test question in itself. The second thing we're going to look at is the number of miles that you drive annually. Annually. Not number of miles you drive to employment. All right, it's the number of miles you drive annually. Keep that in mind. How many years you've been driving, the more years of driving experience, the better the rating will be. Okay, and any other factors that have a substantial relation to the risk, that would be like your geographic location of where you live. Okay, that's what that's about. Okay. Also, for married couples with children, you tend to be a little more conservative in your driving. And so that's also somewhat considered by insurance companies, okay? So again, for liability, it's how you drive, okay? So Under tort law, a person can face a claim for legal liability on the basis of all of the following except breach of contract. So yeah, I threw in some random questions here, just so you know. A tort is a legal wrong other than a crime or a breach of contract. So tort does not cover contract law, and tort does not cover criminal, because that's criminal law. But these are types of torts. Negligence makes up the biggest area of tort law. Negligence is defined as failure to do what a reasonable and prudent person would do in a given situation. All right. Intentional torts can actually be covered. All right. And absolute liability, think of workers' compensation, where if you are an employer, you have employees, the law requires that you maintain workers' compensation to protect your employees. And so the public holds you, the employer, absolutely liable for all losses to your employees in the course of the business. Okay. So these are some types of questions you may get. And I mean, a lot of times you see this, like, what the hell are they even talking about, right? So be wary of that. So now we talked about rating for liability. Let's talk about rating for physical damage. And for physical damage, I just want to know what type of car you have. So I need to know the year, make, and model. So that's what you drive. Liability is how you drive. Please remember there's absolutely no coverage in Mexico. Okay. Now, some of you think, hey, wait a minute. If you get the Mexico coverage endorsement, it does cover you in Mexico. But in general, no, your personal auto policy has a territorial limit, and it will not cover you in Mexico. All right? So that's one test question. The other test question is if someone purchases the Mexico coverage endorsement, now how far will it cover you? Okay, and that's when it's 25 miles into Mexico from the U.S. border. Okay, but in general, your personal auto policy will not cover you in Mexico at all. Okay, I already said earlier, your policy doesn't cover intentional accident, wear and tear. It's never covered by insurance. All right. So again, these are some common questions right here. All right, when an automobile insurance policy is canceled at the request of the insured, and the insurance company keeps all the earned premium in addition to an amount to pay for overhead expenses incurred by the insurer, this is called what type of cancellation? And it's going to be short rate. So what that means is, let's say you paid for the whole year for your auto insurance, paid annual premium, okay, and you cancel 6 months into the policy. So we're going to keep the earned premium, which is the first 6 months premium, because we covered you. And then when you cancel out, we're going to basically return the unearned premium minus a small charge for overhead expenses. And so you kind of got shortchanged for leaving, and that's why it's called a short rate cancellation. So keep the earned, return the unearned or unused minus a fee, like an overhead expense or admin charge, okay? The question can change when an automobile insurance policy is canceled at the request of the insured, and the insurance company keeps all earned premium. This is referred to as what type of cancellation? This is going to be prorate. So again, you paid for the whole year. Let's say you cancel on the 6th month. We're going to cover you for the first 6 months, so we get to keep that first 6 months premium, and then we return the second 6 months premium because we're not going to cover you. That's a prorate or pro rata cancellation. All right. Now, if you cancel the policy, we return all the premium. That means we don't keep anything. This is called a flat rate cancellation. Void the contract, refund all the premium. We pretend like the policy never even existed. That's a flat rate cancellation. Okay. And again, in the playbook on my website, it's in there. Okay. The playbook I have on my website, it's basically like if you were to make flashcards, that would be it. When you see the heading, then make sure you look for this is the answer. And you'll see this. I have a couple of charts on there. All right. Replacing a vehicle. Now, this is where those of you that have real-world experience, this is going to trip you up a bit. All right. So if you have liability coverage, you drive a Volkswagen Bug. Now, remember, for liability, we're not even covering your Volkswagen Bug. We're just covering you driving it. And so if we replace your Volkswagen Bug with, let's say, a Cadillac Escalade, and for liability coverages only, you don't even have to tell us, the insurance company, until at the end of the policy period. Because remember, for liability, where you have a car, you're replacing it for another car, we're not covering the car. So you have one car and you replace it for another car, so there's still only one car on the road. All right. So the risk hasn't changed. All right. And since we're not covering the car, we're just covering you driving, the liability risk hasn't changed at all. And so you don't have to tell us. You're automatically covered to the end of the policy period. Now, if you have liability coverage only on your Volkswagen Bug and then you buy another car, that's when you get the Cadillac Escalade, for liability coverages only, now you have to tell us within 14 days. Because you had one car, and in the first section, you replaced it with one car, so it's still only one exposure on the road. But now you had one car, and now we're adding another car, so now there are two exposures on the road. So when the risk changes, we, the insurance company, need to know. And that's when you have to tell us within 14 days. Now remember, this is only for liability. For physical damage, it's a little different. If you have liability coverage only and you either replace or get another car and you want to add physical damage, since you don't already have physical damage, you have to tell us within 4 days. But if you already have physical damage, like you have liability and physical damage on a car, and then you get another car or replace it with another car, then you have up to 14 days to tell us because you already have the coverage. So those of you with the real world experience, in the real world, we usually use a 30-day rule, that if you buy a new car, you have up to 30 days to tell the insurance company, okay? And that's great in the real world. That's not how you need to know it for this test, okay? So these are the things you need to know for the test. Whoops, okay? And again, this is in one of the handouts on my website, under the sample test questions, I have additional information, and this is on the auto sheet, okay? All right. So Dave has an automobile insured by a personal auto policy. He trades in his car and purchases a new private passenger auto as a replacement vehicle. If he does not notify the insurance company, the liability coverage for his replacement vehicle will apply automatically till the end of the policy period. Okay. Remember, it's a trade-in, and he only had liability. Okay. So under a personal auto policy, if a newly acquired auto is to replace the covered auto with liability coverage only, how long does the insured have to request collision coverage? So you had liability only on the first car, and then you replace it with another car, and now you want physical damage coverage when you didn't have it before. That means you have to tell us within 4 days. Okay. So these are the types of questions you're going to get. And for those of you, again, throw real world experience out the window and just listen to this or listen to me to get through your exam. Once you pass your test, then you throw this stuff out the window and you pull that real world knowledge back in. Okay. All right. All right. So if an insured timely requests coverage for a newly acquired auto under an existing personal auto policy, what coverage will be provided or is provided before the request is made? And that would be the broadest coverage of any vehicle on your deck page. So let me explain. Let's say you own two cars. One has liability and physical damage coverage, and then one of your cars only has liability. So if you rent a car or you buy a new car, whichever car in your declaration page has the better coverage, that's the coverage you'll have for the rental car, or that's the coverage you'll have on the new car that you just bought. Okay? Just so you know. All right. Endorsements. The definition of an endorsement, keep it simple, it's additional charge for additional features and benefits. Right? There's no such thing as a motorcycle policy. There's no such thing as motorcycle coverage. Yeah, you'll see it in the commercials because it's easy for the public to understand it, but there's no such thing. It's an auto policy with an endorsement called miscellaneous type vehicle endorsement, which basically defines that this auto policy is covering a motorcycle. Okay? So that's what that one's about. Now, it may not be a motorcycle. It could be a dune buggy. It could be a golf cart. It could be an RV. Okay. But that's what miscellaneous type vehicle endorsement is all about. Named non-owned auto coverage. This is for someone who lives like in a city that doesn't own a car. Right? So, they rely on public transportation or rideshare. Right? Or, maybe they borrow their friends' cars or they rent cars for long trips. Okay, so this is only liability coverage, again, for someone who doesn't own a car. All right, keep that in mind. You can't get physical damage coverage for a car you don't own. Now, extended non-owned auto coverage is, let's say you have a car, you have a personal auto policy covering you driving your car, but then you work for a company and they're going to give you a company car. Well, your personal auto policy excludes vehicles that are furnished for your regular use. That means if you're driving the company car and you get into an accident, it's your fault, and someone sues you, and that lawsuit exceeds the coverage that your employer got for you, your personal auto policy excludes coverage for that loss. So that if your employer didn't give you enough insurance, well, you're starting to liquidate your assets because you got into an accident while using a company car. So if you add this endorsement to your policy, the extended non-owned auto coverage, right, this can actually lift the restriction, and it's going to extend coverage to a car you don't own but is furnished for your regular use. That's how you want to view that. Right? Please understand that occasional use of a vehicle, not a problem. So if you borrow your neighbor's car and you get into an accident, it's your fault. It was your neighbor's car. Your neighbor's insurance pays first. Okay. Likewise, if the neighbor borrows your car and gets into an accident, it's your car, so your insurance would be primary. It pays first. If it's not enough, the neighbors would be secondary or excess. So always remember, insurance follows the vehicle. Now that's for occasional use. But a car furnished for your regular use would not be covered unless you added this endorsement to your policy. Not to the commercial policy, it's to your policy. All right, you can get the limited Mexico coverage endorsement. All right, covers you up to 25 miles into Mexico from the U.S. border. Make sure you pick 25 miles from the U.S. border, not the Mexico border. And it's good for up to no more than 10 days while visiting Mexico. Okay. All right. So which of the following best describes a tortfeasor? And it's someone who is negligent. This is a common test question. I don't think you got this anywhere in your online training. So a tortfeasor is someone who commits a tort, someone who is negligent. Okay. So what is the difference between a personal auto policy and an ISO personal auto policy? Some of you have been studying. You guys know the difference?
They're the same.
They're exactly the same. Don't get tripped up, because didn't we say we get all our policy forms from the ISO? This isn't even your question. Right? Under a personal auto policy, liability covers other people, right? So under an ISO PAP, liability covers, well, it's still other people. Okay. And by the way, unendorsed personal auto policy is also the same thing. Just look at the name. Unendorsed means there's no endorsements. You bought a personal auto policy, which is the same as a personal auto policy, which is the same as a personal auto policy. Don't get confused or tripped up by that. It's just adding a word in front of it to throw you off. And it works. Because some of you study, and all you study is under personal auto policy this, under personal auto policy that. Then you go take the test, and now it says under an ISO PAP. And you're like, what the hell is that? We didn't cover that. And it makes you think that it's a whole nother type of policy when it's not. It's still a personal auto policy. The named insured are people that are named on the policy, like Jack and Jill Hill. Right? So they're both named on the policy. The first named insured would be Jack Hill, right? Because I said Jack and Jill Hill. So the first named insured controls the policy. And you need to understand that. Who is responsible for paying the premium? First named insured. Who can cancel the policy? First named insured. Who gets any premium refund? First named insured. Who can request changes to the policy? First named insured. So even though they're both named, the first named insured is the one that controls the policy. All right. Now, an insured is anyone covered by the policy that may not be named. So Jack and Jill Hill own a car, and the neighbor needs to borrow it to go to the store, and so they borrow with Jack and Jill's permission, and the neighbor gets into an accident using Jack and Jill's car. They would still be covered by the policy because they're using the vehicle with Jack and Jill's permission. All right. They're insured by the policy. They're just not named. Okay. I mean, it seems really fundamental, basic, but when you're stressed out and you're taking a test and you're hoping you do well, a lot of this gets jumbled. So again, through repetition of the sample test questions on my website, you alleviate that guessing game. All right. So if an insurer pays an insured $25,000 in lost wages $45,000 for physician's visits and hospital costs, and $15,000 for physical therapy treatments, and later finds out that the claim was fraudulent, the insured may be fined as much as, it's going to be $170,000 if it's a fraudulent claim. The penalties for submission of a fraudulent claim, number 1 is a felony. Number 2, it's up to 5 years in prison per count. Number 3, it's up to a $150,000 fine or double the value of the fraud, whichever is a larger number. So if you add these up, the $25,000, $45,000, $15,000 is actually going to equal $85,000. And so we have to double that. $85,000 times 2 is $170,000. $170,000 is more than the $150,000 normal fine. And so the larger of the two numbers is what we pay. It's a $150,000 fine or double the fraud, whichever is the larger number, that's going to be the fine. Okay, and that's what this is about. Okay. So now we're on standard fire policy, which we kind of touched on. Like I said, it covers fire, lightning, and removal. It's a named peril policy. All right, so if it's not on this list, like windstorm, it wouldn't be covered. Hail, I don't see hail on this list. So if hail damages your house and causes it to collapse, it will not be covered. Okay, oops, okay, so keep that in mind. Now removal, remember your house is on fire, you're trying to remove stuff out of the burning building to protect it from further loss, again, without endangering yourself, okay? But that's all this policy covered. It's extremely limited. We don't even sell it anymore. It gets a name from the fact, the standard fire policy, it gets a name from the fact that it's the only policy where the wording is actually standardized by law. That means if you get a hold of a California insurance code book, you rummage through it, okay? This whole policy verbiage is laid out in the California insurance code, okay? All the other policies are basically based on companies' attorneys that come up with provisions and conditions, okay? Now, fire, lightning, removal is definitely not enough coverage to cover your house if something happens. And so, for a slight additional charge, you can purchase what's called extended coverages. Sometimes on the test, you just might see EC, extended coverages, okay? And extended coverages would be WARVs. These are abbreviations: windstorm, hail, aircraft, riots, vehicles, explosion, and smoke, okay? So again, on my website, if you go to the playbook, page 5, if you were to print it up, would have WARVs, and it explains. And so a lot of times the question is going to ask you, which of the following is not an example of an extended coverage peril? Excuse me here. Okay, so windstorm, hail, aircraft, riots, vehicle explosion, smoke are extended coverages, then you should know that earthquake and flood are not. All right, so it's seemingly blatant, straightforward, but again, you need to get stressed out, you don't think properly, so be wary. All right. Now, if you buy extended coverages, then we'll let you buy vandalism and malicious mischief. But remember, for vandalism, there's a 60-day limit. What that means, if no one's watching your house for 60 days, it kind of becomes a target for vandals, and so we won't cover vandalism losses after 60 days of being vacant or unoccupied, okay? So, if you take an extended vacation more than 2 months, my recommendation is get a house sitter so your house doesn't meet the definition of vacant, and if there's a loss, it's still covered, okay? All right, what perils are insured against under the additional coverages, property removed of a homeowner's policy? And it's all perils, all risk or open peril, all right? So what that means is, let's go back. Your house is on fire. Lightning strikes your house, causes fire. You call 911 after you get your family out, and you're trying to remove your property from the burning building, and as you take it out, someone steals it, okay? Well, the unavoidable theft during removal is covered. So if it wasn't for you trying to take property out of the burning building to protect from loss, theft would not be covered at all, okay? And so that's what we're saying here. But this is the test way of saying, during a period of removal, what type of coverage do you have? Okay, and it's all risk. So you see the way they word these questions, you almost don't even recognize the topic. Okay, And so you got to go through the questions over and over and over again until you're familiar with it. Whereas you're reading the question, you kind of have an idea what the answer is. You just got to find it. That's how you want to study to pass this test, is through repetition. So take the time. What is the difference between a standard fire policy and a dwelling policy basic form? Okay, well, the perils. Standard fire policy covers fire, light, and removal. A dwelling policy basic form, or DP1, covers fire, lightning, and instead of removal is automatic, it covers internal explosion. Okay, and you got to know these because they're going to be two questions, not necessarily side by side like I have here, but it's very common. Okay, and so you got to know the difference. All right, dwelling policy basic form is fire, lightning, internal explosion. Standard fire policy covers fire, light, and removal. All right. So let's say, the test will say under a standard fire policy, which of the following is a covered peril? You're going to get this as an answer, but you'll probably also get this as an answer, and you got to know the difference. Okay. Standard fire policy is fire, light, and removal. A dwelling policy is fire, lightning, and internal explosion. Okay. So now you will get some comparison contrast questions. It's very common on this test. So now we're going to jump into homeowners. All right, but before we do, I want to just take a quick breather here. Any questions out there so far?
No, we're good. We're following.
Okay. If I go too fast, slow me down. I've had coffee this morning and not this afternoon, so I'm like, it's hitting me like a wall right now. So it's been a long week, but it's been good. All right.
Okay, awesome.
All right. So homeowners, I mean, there's different ways of setting this up. I kind of set it up this way. Again, all these screenshots are actually sheets that are on my website. Section 1, homeowners section 1 is property. All right. And then section 2 down here is the liability coverage. Theft is included in all the homeowners policies. There may be what's called sublimits, which we'll get into. But your homeowners policy is a self-contained package policy. Covers property, theft, and liability. Okay, and so I basically say, in comparing this versus dwelling, let's go to a Mexican restaurant. Hopefully you guys like Mexican food. All right, and when you go to a Mexican restaurant, there's typically two menu boards. All right, one of the menu boards is the a la carte menu. Hey, I want a burrito, or hey, I'd like the 2 tacos, or maybe an enchilada. But it's just you buy this single item. That's the a la carte menu board. And then the other menu board lists the combos, the burrito with rice and beans on the side, or the 2 taco combo plate, whatever it may be. Okay. Well, homeowners would be the combo plate. All right. It covers property. Whoops, go back here. Bing, bing, bing. All right. So it covers property. That would be a burrito. And so you're going to pick a burrito depending on what you're hungry for. We're going to get into this in a minute. Theft would be the rice, and liability would be the beans. And so it's all included. So the burrito, rice, and beans. How's that? Okay. So now we're going to talk about these coverages. So when you first get out of high school or college and you got a job where you're survivable, sustainable, and your parents kick you out of the house, you're probably going to rent. And so you're going to start with an HO4. This is a renter's policy. Remember, there's no such thing as renter's insurance. It's a homeowner's policy that's designed for a renter. Okay. And so you're renting a place. Now, the thing about a renter's policy is there's no coverage A for dwelling. There's no coverage B for other structures for you. Because as a renter, you don't own the building and you don't own the separate garage or any other structures. All right. Remember, if you don't own it, you cannot insure it. All right. So you're covering your belongings, which is personal property, in someone else's building. Okay. So renters has covered C, personal property, which, by the way, under homeowners, your personal property is covered anywhere in the world. So even though you cannot drive to Mexico City and be covered by your auto policy, even with the endorsement, because it's more than 25 miles, okay, if you fly into Mexico City and you stay in a hotel and the hotel burns down, your personal property is covered in the hotel. All right, remember, personal property under homeowners is covered anywhere in the world. Okay. Now, let's say this apartment you're staying in burns down. Coverage D is loss of use. This covers the cost to put you up at a hotel or give you the money we just pay you out, where you can put a deposit and just live somewhere else from then on. How's that? But that's what loss of use coverage is about. Someone could steal your stuff. Theft is included. There are some sublimits, right? Theft of jewelry has a $1,500 sublimit. That means anywhere in the world you're out and about, if someone steals your jewelry, the maximum you'll get is $1,500. Okay? So if your jewelry is worth more than that, then we'll talk about some jewelry coverage to increase limits on the jewelry. Liability standard limits are $100,000. And by the way, liability, just like personal property, covers you and your family members while you are anywhere in the world again. So now you're visiting Italy, right? And you hit the golf course and you shank the ball, and your ball, flips off and goes and hits some guy in the head, puts him into a coma. This little liability policy, or this liability section of your renter's policy, covers you because that was an accidental injury to someone else. All right? So personal liability covers you and your family members while you're anywhere in the world. The exception, of course, remember, intentional acts is not covered by insurance. Okay, so for renter's insurance, that's how you need to know it: personal property, loss of use, and again, liability. So let's say we saved up some money where now we move in and we actually buy a condo, one of our smaller initial investments. Okay. Well, if you own a condo, now you need some structures coverage, because if you own a condo, you own the kitchen cabinets, the bath, and the fixtures, the cabinets. Okay. And so we need some structures coverage if you own a condo. All right. But there's no coverage B. Because the carport that everyone parks at when they own a condo, that's covered by the condominium association policy. All right. Now, if you are responsible for a garage or carport, we can add it on. But in general, as for a condo owner, the HO6 doesn't cover other structures. Just like renters, we do cover your personal property anywhere in the world. And if your condo burns down, we're going to give you some money to stay in a hotel till we rebuild your condo so you can move back in. Okay. Theft and liability are also included, just like renters, covering you and your family members anywhere in the world, right? And your property if it's stolen anywhere in the world. But again, there are sublimits. If someone breaks in and steals all your jewelry, the maximum you're going to get is $1,500. Right? And so we'll talk a little bit in a minute about how to increase the limits on that. All right. So now, by the way, the HO6 is for a condo owner. It doesn't matter where the condo is, whether it's in downtown in the city or out in the farmland community. A condo is a condo is a condo. Okay. Another thing your test might do is I might put under an ISO HO4, which is still the same as an HO4. It may say under an unendorsed HO6, which is the same as HO6. Remember, just by putting that word or the ISO in front of it doesn't change what it is. HO4 is for renters, HO6 is for condos. Right? So now you save up some more money. Now you're going to buy a house. Right? Now, when you buy a house, you have three options. You have HO2, you have HO3, you have HO5. This is good. HO2 is good. HO3 is better, but HO5 would be the best if you own a home. Okay? So let me explain. An HO2 is a broad form policy. So we're going to give you broad form or name peril coverage on the structures, and also name peril coverage on your stuff in the structures. Okay, so I basically say so-so coverage on the structures. Oh, I keep clicking it. Sorry about that. So-so coverage on the structures and so-so coverage on your stuff. Now, HO3 is better because we're going to give you all risk coverage on the structures. Okay, remember all risk. Whenever you see all risk, pay attention to exclusions. If it's not on the exclusion list, it's covered. And so we're going to give you great coverage on your structures, but just so-so coverage on your stuff. So we've already moved from so-so coverage on the structures, so-so coverage on the stuff, to great coverage on the structures, but still so-so coverage on your stuff. And so HO5 is going to be the best because you have great coverage on the structures and you have great coverage on your stuff. Okay. The only difference between an HO3 and an HO5 is the coverage on Part C, personal property. HO3 has name peril coverage on your belongings, but HO5 is all risk. That means pay attention to exclusions. And you know what's not an exclusion? Is mysterious disappearance. Mysterious disappearance is covered under an HO5. It would not be covered under an HO3. Okay. Mysterious disappearance is you have a couple earrings sitting on the counter, and one of them just somehow disappears. Okay. It's not theft. It's not a theft claim, because theft, they'd have grabbed all your jewelry and taken off with it. Okay, just an earring disappeared. Maybe it fell down the garbage disposal, or rolled off the counter someplace else. Okay, and under an HO5, you can file a claim and it can cover that. Okay, because it's not an exclusion. Loss of use covers the cost, like I said, to put you up at a hotel. till we rebuild your house, your condo, or rent or apartment if you're renting. Until they rebuild it, you can move back in. Like I said, theft is included in all the policies, right? And liability is included in all the policies based on the limits you set. This is a minimum liability, $100,000 on all our policies. You can always buy more. And so when you're sitting with a prospect, you definitely want to do a liability exposure worksheet to see what they have at risk, and then recommend coverages, liability coverages to match that. Okay. So that's a homeowner's policy. Now, there is an HO8 for antique homes. It's extremely rare as far as the test, but you may get that. HO8 is for antiques, older homes, like Victorian-style homes in San Francisco and Alameda. It only pays actual cash value. You see, if an antique home burns down, we can rebuild it to look just like it did before the fire, but it's not an antique anymore. And so we pay actual cash value. We just cash you out. Okay. Additional coverage on your homeowners. If you actually borrow your neighbor's camera, take a trip to Europe, and you drop it and it bounces into that fountain in Italy, we only give you $500 for replacing their camera. Okay. If you're part of a condominium association or homeowners association and they want to re-roof and they're going to do a $4,000 loss assessment to you, your homeowners policy can give you $1,000. You can always buy an endorsement and increase this coverage. In the real world, I would recommend it. But for the test, these are some of the limits you need to know. In California, we have a mandatory endorsement, and that's workers' comp. So in all of our homeowners policy, where it's a renter, a condo owner, or any of the homeowners, workers' compensation is built in. Now, it's typically designed for you have up to 2 in-servant employees. That means people that live in the house to keep it up, like a maid or butler. But for the test, it's mandatory as an endorsement on your homeowners policies in California. Okay. Some other items here. If you own a condo, HO4 or HO6 can actually be used if you're a condo owner. HO6 is the better one, but they may not give you just HO6 as an answer. It'll say HO4 and or HO6. And so be wary of that. Okay. HO2 or HO3 can actually be used to cover a mobile home. It's an MH200 endorsement. To be covered, the mobile home must be at least 10 feet by 40 feet, and that mobile home must be worth at least $4,000 to be covered. Okay. And like I said, HO8 is for antique homes. Okay. Just in case you get that one. HO1 we do not sell in California, just like the standard fire policy. It's pretty much gone obsolete. Okay. Standard fire policy you will get test questions on. HO1 I haven't seen. Okay. HO8 I didn't get it on my test, but someone said they saw an HO8, and so I just want to emphasize that it's for older homes, antique homes. And remember that an HO8 pays actual cash value. Okay. All right, so let's say we have a home. All right, so you bought a house, and now you're looking to expand and have some residual income, and so now you're going to buy another property. You're going to be a landlord. Well, that's what the dwelling policies are about. So these are the dwelling policies: DP1, basic form; DP2 is broad, and DP3 is special. So for the test, view it as a landlord. See, in order to buy a homeowner's policy, the property must be what we call owner-occupied. That means you own it, and you live in it. Okay, dwelling may or may not be owner-occupied. So let's say you own a building and you rent it out to someone else. All right, let's say there's 2 units like a duplex, and you own it and you rent it out to 2 renters. Okay, you cannot buy a homeowner's policy on that property because you don't live there. That means you're going to have to go to the dwelling policies, and view this, like I said, as a landlord policy. So DP1 basic, right? We have 5 coverages: A, B, C, D, and E. I use DOPRA. Okay. Homeowners, oops, I keep doing this. All right. Homeowners is only there's 4 parts for property. Coverage A is dwelling, coverage B is other structures, coverage C is personal property, and coverage D is loss of use. So homeowners is DOPL, DOPL. Dwelling, this thing's tripping out here. Okay. Dwelling is 5 parts, DOPRA, DOPRA. So homeowners is DOPL, dwelling is DOPRA. Okay. All right. So now looking at the DP1, one of the things we need to notice is coverage A, additional living expenses. All right, so if this place burns down and you got to stay at a hotel, this is optional on a DP1, so it's kind of scaled back. The perils on a DP1 are fire, lightning, and internal explosion. Okay, you can pay. Stop. Just apologize. This mouse is kind of temperamental here. Okay, you can buy extended coverages and vandalism, but rather than buy it and add it to this, let's go to a DP2. Because DP2 covers the basic perils, which are fire, lightning, extended coverage is built in, vandalism is built in, falling objects, burglary, collapse, and there's 7 other perils that are also covered by the DP2. But it's still a named peril policy, so it's quite limited. The DP3 is an all-risk form. That's the special form. Remember, we pay attention to exclusions. Anytime you see all risk, open peril, special form, pay attention to exclusions, because if it's not on the exclusion list, it's covered. Okay. All right. So here's acronyms. Actual cash value down here, replacement cost. Actual cash value is defined as replacement cost minus depreciation. Replacement cost means what does it cost to rebuild it brand new without depreciation. And another thing for terminology, coverage B, which is other structures, on the test, sometimes they'll use a pertinent structure. That's another way of saying other structure or a separate structure. That would be like a separate garage or your fence, okay? It's a separate structure on the premises, okay? Now, remember, dwelling is going to the Mexican restaurant and eating off the a la carte menu. So pick a burrito. Did you want the bean and cheese burrito, the bean and cheese and chicken and rice burrito, or did you want the gourmet burrito, the burrito special, right? Burrito especial. How's that? Okay, so this one's good. This is better. This is the best. Now, when you pick a burrito, would you like rice and beans on the side for a slight additional charge? Well, that would be the theft and liability coverage. Remember, homeowners, it's a combo plate. Property, liability, and theft are all built in. Dwellings, a la carte. Pick a burrito. Liability and theft are optional and can be added on for a slight additional charge. Okay? So, again, it's to cater to what you want as a consumer. Coinsurance. Some of you hate math. It's great. Let it go. You may get 2 to 3 math questions, and it's typically going to be based on this equation right here. This could be a test question all by itself, by the way. What is the coinsurance equation? And it's the amount of insurance you did have divided by the amount of insurance you should have. That's going to be this fraction. You take whatever this fraction is, you multiply by whatever the loss may be, that'd be the claim, and that's how much your company will pay for the claim, minus any possible deductible. Sometimes the question will actually say disregard the deductible, okay? So an example here is we have an apartment house worth $500,000. The owner insures it for $300,000. The policy has an 80% coinsurance clause. Now, when it says that, that means the company is requiring that you carry at least 80% of coverage to the value of the property. Okay. If you insure for less than that, you're going to have to pay a higher portion of the claim. So, all right. So our person bought $300,000. There's an 80% coinsurance. Lo and behold, there's a $200,000 loss. How much will the insurance company pay? Give you guys a second. Break out your calculators if need to. Okay. Everyone's quiet. They all like passed out, huh? Let me unmute. So what do you guys think? Wow, you guys really hate math, huh?
120,000.
120,000 is one answer. All right. Anyone else?
I mean 150.
Oh, she changed the answer. All right, you're right. It's actually going to be, it's going to be 150. Okay. So going back to the equation, the amount of insurance you did have, which is a $300,000, divided by the amount of insurance you should have. Now, should is not the value of the building because the company says you only need 80%. So 80% of $500,000 is $400,000. So you did have 300,000 divided by you should have had 400,000. That simplifies to 3/4. 3/4 times the 200,000 loss equals 150,000. That means if this was you, we, the insurance company, are only going to pay 150,000 towards your 200,000 loss. That means you got to pay the $50,000 difference because you didn't have enough insurance. So this is what we call the coinsurance penalty, where if you don't have proper insurance, you're going to have to pay a greater portion of the claim or the greater portion of the loss because of that. Okay, so get this equation down. It is in the playbook on my website. You will get some math questions on the test, like I said, and this is one that's very common. Even if you suck at math, if you go through this question a few times, just by recognizing the numbers, you'll know the answer. Okay. This one doesn't have a deductible. Sometimes it'll say disregard the deductible, or sometimes this one may say there's a $1,000 deductible. So, I mean, they'll give you some more information on it. Okay. So be wary of that. All right. Like I said, even if you suck at math, you can miss 60 questions. So let's say you get 3 math questions, you can still miss 57 more questions and pass the exam. Okay. I kind of laugh when people say, "Oh man, you know, Lauren, I missed it by 2 questions." I'm like, no, you missed it by 62 questions, right? The 60 you're allowed to miss plus those 2 that you're saying was all you needed. That's a big gap in your studying. That's like almost 1/3 of the test, folks. Okay. And so the first question I ask you is, did you go through all my sample test questions at least twice? And if you did, well, then I'll meet with you one-on-one. We'll cover the weak spots and get you geared up and get you ramped up and pass that test. Okay. But if you didn't, you know, you got to take the time to do it. Okay. So valuation clause. If you suffer loss, how are we going to pay? This is called the valuation clause. All right. So replacement cost is what it costs to replace, restore, rebuild brand new. Okay, so for homes and dwellings, we typically insure the building on a replacement cost basis. If your house burns down, you want it rebuilt just like it was. You want that 3-bedroom, 2-bath house rebuilt just like it was before the fire. Now, for all your belongings in the house, we're going to cover it on an actual cash value basis. So what would it cost to replace your big screen TV minus depreciation? That's what we're going to pay. Okay, so be wary of that. Okay. Yeah, actual cash value is replacement cost minus depreciation. Now, the test may give you a question saying the original price for furniture is like $9,000 and it's destroyed by a fire. To replace it at today's prices costs $11,000. Assuming $6,000 in depreciation, how much will the policy pay? Whenever it says original cost, throw that out. It's useless knowledge. It doesn't come in and help you answer the question because the original, you can't get that furniture at $9,000 anymore because it costs $11,000. Okay, so replacement cost is $11,000. Replace it brand new today minus the $6,000 depreciation. So we're going to pay $5,000 on that loss. Okay, don't use the original price because that'll throw you off and yeah, you'll pick a wrong answer there. Okay, market values. If that property were sold on the open market, what would you get for it? Okay, like if you got into an auto accident and you totaled your car, well, if you were to sell it the day before the accident, what would have you gotten for it? That's kind of the market value. So we'll pay the amount of the damage to the car or the actual cash value or the market value, which is stated in the contract. Now, the stated value valued policy, again, like I said, think of fine arts and antique cars. So let's say you have a acrylic painting. It's a very unique painting. And 1/4 of that painting is destroyed in a fire. It's not a total loss because only 1/4 was damaged. However, you can't really replace 1/4 of a painting. All right. So it's a partial loss, but we'll still give you the full payout. That's a stated value or valued policy where we pay an actual cash value for the loss up to the stated value that you and the insurance company agreed to in the contract. Okay. So if you ever suffer loss for property, it has to have a valuation clause of this is how we're going to pay to restore or replace it. Okay. All right. X is in an accident with Y. X suffers $5,000 of damage, but it is determined that Y is 60% responsible for the accident. How much would X receive under contributory negligence rules? Now, this is part of tort law. And I got to be honest with you, in California, we do not have contributory negligence in California. Okay? But contributory negligence, if you contribute in any way, shape, or form to the loss, towards the loss, you get nothing. That's what contributory negligence is all about. Okay? Now, that got replaced by comparative negligence. So the question is like, it looks exactly the same, all right? X is in an accident with Y. X suffers $5,000 damage, but it's determined that Y is 60% responsible for the accident. How much would X receive under comparative negligence? Okay? And whenever you see comparative, think compare, and compare we share. And so since Y is 60% responsible, X gets into an accident, Y is 60% responsible, then X can X can collect the 60% of the loss. That means X contributed 40%, and you can't you can't collect on what you contributed, but you can collect on what the other person is responsible for. Okay? You probably will get 3 to 5 questions just on contributory negligence versus comparative negligence. So remember, contributory negligence, even if you contribute 1%, you collect nothing. If you contribute in any way, shape, or form, you get nothing. But comparative negligence is where we share in the claim cost. Prime example of this is 2 people backing out of a grocery store parking lot at the same time and they bump each other. One is 51% at fault, one is 49% at fault, and their insurance companies share in the claim. That's comparative negligence. That's actually what we have today. Like I said, contributory negligence really doesn't exist in California, but it's going to be on your test. Okay, so make sure you know the difference. Some other personal lines coverage, excess liability versus umbrella liability. So let's say you live in the city and you don't own a car. But you own a home in the city. Okay, well, you want additional liability in case you have a house party and someone slips and falls and they try and sue you. And so you can get excess liability, which is liability over one line of coverage, such as liability in your home, which is personal liability. Okay. Now, umbrella liability is higher limits and broader coverages. So now umbrella would be you have a homeowner's policy with adequate liability. You have an auto policy with adequate liability. Then you can buy an umbrella. It's going to be additional liability over multiple lines, like auto liability, your auto, and personal liability, your home. Okay. Excess liability is only additional liability over one line of coverage. Okay. So whenever you think umbrella, think higher limits, broader coverage. Excess liability is only higher limits on one line of coverage, one type of coverage. All right. Floaters. Personal article floater versus personal property floater. Now, these are 2 types of what we call inland marine coverage. All right. So if someone breaks in your house and steals all your jewelry, for the test, your homeowner's policy will give you a maximum of $1,500 for theft of all your jewelry. Oh, that's great, isn't it? So if your jewelry is worth more than $1,500, sorry, your insurance company and your homeowner's policy only pays up to $1,500. So if you want to increase the coverage amounts, well, then you would get inland marine coverage, which in this case is called a floater. Now, even though jewelry typically doesn't float, and even if it's called inland marine or floater coverage, it really has nothing to do with boats at all. It's just giving you higher limits of coverage on your valuables, such as jewelry, firearms, silverware, fur coats, sports card collections, baseball cards, okay? Now, the difference between a personal article floater and personal property floater is your personal property floater is what we call unscheduled, okay? So you have more than $1,500 in jewelry, let's say, but you don't have more than $7,500. And so you can get this to just give you a little additional coverage for jewelry, but nothing overly expensive. And so this is going to be unscheduled. Unscheduled means I don't need a list of your jewelry. However, at the time of the loss, you will have to show proof. Now, if you got some high ticket items, that means we need a personal article floater. Okay. So let's say you have an $85,000 diamond necklace, all right? Then you want to get a personal article floater because it's worth more than 7,500. This one kind of has a limit of 7,500, and this is more. Your jewelry's worth more than that. Okay, and so you want to personalize that. Now, for personal article floater, I need a schedule. Schedule means I need the list of the jewelry, a description of the jewelry, and what is the appraised value of the jewelry. So if something happens, we know what we're paying. Okay. So again, your homeowner's policy gives you $1,500 for theft of jewelry. If you have a little bit more than that, go with a personal property floater. But if you have high ticket items, go with a personal article floater. This is scheduled. This is unscheduled. Okay. And again, you'll go through, you'll see that on my sample test questions on my website, and you want to start practicing that. All right. What is a self-insured retention under an umbrella policy? And it's a deductible that applies towards losses that are not covered by an underlying policy, but can still be covered by the umbrella. Okay. So in order to get umbrella, you need auto liability and you need personal liability like a homeowner's policy. Okay, so let's say you get the two, you buy an umbrella. And then as a homeowner, you rent out one of the rooms because, you have a tenant there and them paying rent helps you meet some of the bills, okay, because your kids have moved out. Now, let's say this renter stops paying rent, and so you evict them. And when you evict them, they actually talk to an attorney, and they turn around and they sue you for wrongful eviction, claiming you're unfairly discriminating against them because they have purple hair. Okay. Now, you should have gotten personal injury coverage because that covers that lawsuit like, the mental anguish, wrongful eviction, libel, slander, defamation of character. But you didn't buy that and add it to your homeowner's policy. So when you evict this person, they sue you for wrongful eviction. You didn't have the coverage, but you had an umbrella policy. This is a liability exposure. So since your underlying policy doesn't cover it, you can pay a self-insured retention, which is basically a $250 deductible, and then your umbrella can kick in and cover that legal claim against you. How's that? So it's higher limits, broader coverage, even areas where it's a liability exposure that isn't covered by an underlying policy. Okay. Realistically, an umbrella is probably the best. I don't know. I guess it's the most practical type of insurance you should have or could have. Most companies, it's about $250 a year in premium for $1 million of umbrella coverage, which is $1 million of additional lawsuit protection. So, yeah, like one of the best bargains in insurance you could have. Okay. All right, so let's talk boats. Okay, so your boats can be covered a couple ways. We're going to start with the personal boats, and that would be watercraft and boat owners and yachts. So let's start with watercraft. Okay, if you have a small watercraft, you can actually add it onto your homeowner's policy. Now, there's a catch. If you have a homeowner's policy and you slip and fall in your own house, your homeowner's policy won't cover you. You and your family should have health insurance to cover you if you're injured in your own house. So that means if I add my boat to my homeowner's policy, if I slip and fall on my boat, it won't cover me and my family. Because if the watercraft is added to my homeowner's policy, it's going to mimic my homeowner's policy, and it won't cover me on my own boat if I slip and fall. It's only liability and medical to other people, like my guests. Okay? Now, in order to add the watercraft endorsement to your homeowner's policy, we need to schedule the watercraft. Scheduled means that I need an itemized list. I need to know that this is a 22-foot bass fishing boat with a 15 horsepower engine. That's what scheduled means. I need to know what type of boat it is. But it's basically liability and medical for scheduled watercraft only. Okay. The better coverage is getting a boat owner's policy. So a boat owner's policy is going to be like an auto policy. You have liability in case you hit someone with your boat. You have medical for you and your family and guests on your boat. And then you have physical damage for the boat. So in this possible test question, a boat owner's policy is similar in design to which of the following? And the answer is an auto policy. Because your auto policy covers liability in case you hit someone, medical for you and your passengers in your car, and physical damage for the car. Okay, so a boat's the same way. Now, Watercraft and boats are typically smaller watercraft, which would be like inland lakes, rivers, and maybe the bay. Okay. A yacht is an ocean going vehicle. Okay. So it's a different shaped hull to stay afloat in large body masses of water. And so we're going to change the coverages. Instead of calling it liability and medical, we're going to call it protection and indemnity. Okay. And so it covers liability in case you hit something like another boat or a dock. It covers medical for you and your passengers on your boat. It also covers workers' comp for the captain and crew that you will hire to take you and your family around the world. All right. Now, a yacht policy is personal. It's still a personal watercraft. Instead of calling it physical damage coverage, we're going to call it hull. Hull covers the ship, the engine, the motor, including the gasoline. Okay. And trailer coverage is optional. Now, these first three are all personal use of a boat. Right? If we're in the business, well, then you want to get ocean marine coverage. So we still need protection and indemnity, which is liability, medical, and workers' comp for the captain and crew. We need a hull coverage, which covers the ship. But other coverages is cargo, because if you're in the import-export business, you're transporting cargo. All right? And if something happens, you're responsible for that cargo that you're transporting. So we need cargo coverage to cover the cargo. But it also includes freight coverage. Now, freight's kind of a unique thing. Let me explain. Let's say you're sending a package to one of your relatives, and you go to the post office to send the package, and they offer you the insurance to insure the package. And so you buy the insurance, which is great. They lose the package. So not only did you lose the package, which is the cargo, you also lost the money that you paid to have the package sent. That's what freight coverage is. That would be like reimbursing a stamp when you send a package. And so cargo coverage covers the package you lost, and freight reimburses what you had to pay to have the package shipped. All right. And so those are the four ocean marine coverages: protection and indemnity, hull, cargo, and freight. On land, we have territorial limits. Remember, you can't drive into Mexico. But on water, we have navigational limits. Okay, there are hostile waters where we won't cover you. Definitely off the coast of Somalia because of pirates. But there's also pirates in the Caribbean, and there are some now pirates off the coast of parts of Mexico now. So they're hostile waters. All right, so now let's kind of summarize a little bit. Homeowners, I said, is that combo plate, right? Covers property, theft, and liability. Remember, the burrito, rice, and beans is all inclusive. And it's 1 to 2 units, like a single family home or a duplex, or you own 2 homes. You live in one, your sister or brother lives in the other. You can cover up to 2 units with a homeowner's policy. But it's got to be owner occupied. And so your immediate family, that would actually classify as owner occupied. We'll allow that. Okay. And again, they don't have to be attached. Another thing I threw on here is a home warranty. It's not on the test, but when you buy a house, you might want to get a home warranty to cover appliances in case they break down, like the washing machine, plumbing, electrical. You pay a deductible when someone comes out there to fix it. Okay. That's kind of a homeowner's policy with the optional home warranty. Well, now for a business, we have a business owner policy. And this is for a small business. When you hear a business owner policy or BOP, think of a mom and pop general store. Nothing extravagant, nothing expensive, because it cannot be more than 6 stories high, cannot be more than 100,000 square feet, and you can't do more than $3 million in annual sales. Like a Subway restaurant does about a million a year. Okay, so that could be covered under a business owner policy. And for the test, you don't serve alcohol. In the real world, for those of you that do commercial, we do business owner policies where we cover restaurants that serve alcohol, but not for the test. Now, Section 1 on a business owner policy covers property, just like a homeowner's policy. Section 2 is liability, just like a homeowner's policy. And so this is kind of a package for a small mom and pop business. Theft is going to be optional. Where theft is built into homeowners, it's optional for a business owner policy. Because again, maybe you just maybe you're an accountant as a small business owner, and all your stuff you store in the cloud. And so if someone steals a laptop, they're only getting a laptop. All your information stored in the cloud. Okay, you can add theft; it's optional. All right. But a lot of times you probably just want to self-insure. You can get a laptop for pretty cheap. As long as you can access the cloud, you can continue running your business. Okay. Now, instead of a home warranty for your house to cover appliances in case they break down, we call it boiler machinery for a business. Sometimes called equipment breakdown coverage. Covers like steam pipes, steam turbines, generators, and things like that. Machinery that's not covered by anything else in the policy, like your property. Okay. Most of your premium for boiler and machinery coverage goes towards inspections to prevent loss. If we do inspections and replace out some worn out fittings to keep from an explosion occurring, that would be very cost effective. Okay. And that's what boiler machinery is all about. Boiler machinery is written as all risk coverage. Anytime you see all risk, pay attention to exclusions. The normal exclusion, like in all of insurance, is intentional action, wear and tear are not going to be covered. Now, the tricky part of that is on your test, it won't say wear and tear. It'll go crazy with a thesaurus and it'll say something like inherent defect. Okay. So inherent defect on the test is a way of saying wear and tear. How's that? Okay. Welcome to the test world, folks. All right. You'd be surprised what you see on this test. And a lot of it, if you don't study well enough, it's gonna kind of look a little Greek to you. Okay. So be wary of that. Don't beat yourself up. I mean, it is what it is. The test is passable, right? But again, I have this terminology on my website in my sample test questions. Make sure you go through them very thoroughly. All right. So you see how it's a combo plate for a small home? And now we have a combo plate for a small mom and pop business. All right. The next step, all right, is we go to dwelling. Now, dwelling is that a la carte menu. Remember, pick a burrito? Dwelling coverage is 1 to 4 units. So a single family home up to a fourplex, right, may or may not be owner occupied. But for the test, when you hear dwelling coverage, think of it's a landlord. Okay. So you own a building, but you really don't live there. Okay. Now for the test, that's how they kind of explain it. On the test, you would buy homeowners instead of dwelling because you want broader coverage. That's one question. But on the test, a prospect would probably buy a dwelling policy instead of homeowners because they don't live there. Okay, so that's kind of the difference between homeowners and dwelling for the test. And so dwelling is, dwelling, other structures, personal property, rental income, and additional living expenses. This is only the property coverage. And for a business, if it's larger than the 6 stories, 100,000 square feet on a BOP, well, then you go to a commercial package. And we're going to start with the property coverage. Okay. Now, dwelling, we have actually replacement costs on the buildings, actual cash value on your personal property. But for commercial property coverage, we pay actual cash value on the structures and the contents. Okay. So keep that in mind. Commercial property coverage is the actual cash value on everything. Now, Part C is personal property of others. Think of like a dry cleaners, where customers leave their clothes to be cleaned with you, and they leave them overnight, and lo and behold, you have a fire at your dry cleaning plant. Other people's property under your care, custody, control is covered here. It's kind of sometimes called Bailey coverage, where you have temporary possession of other people's property. And under your commercial property policy or Bailey's coverage, it would be like normal stuff like clothes. Okay. If you have expensive items under your care, custody, control, that's going to be inland marine, like a jewelry store. Okay. So maybe someone leaves their jewelry store to be cleaned, sized, refitted, and then a loss occurs. That's actually inland marine coverage because those are high ticket items. Okay. Bailey coverage, like I said, think of a dry cleaning, maybe a veterinary hospital where you leave your pet because it's sick to be watched overnight, and something happens where your pet passes away in the care of the veterinary hospital. They have coverage of that. We're going to replace your pet on an actual cash value basis. Okay, so and that's kind of what that's about. Okay, so it's just normal stuff. So commercial property coverages, all right, we have basic, broad, and special. Basic and broad are named peril, special is all risk. But another cause of loss form for commercial property is earthquake. So earthquake is going to be a named peril type of program because it only covers earthquake. And like I said, we cover actual cash value on everything. Your commercial property covers the building and anything in and around the building that you own within 100 feet of the premises. Okay, that means if you take your inventory, you put it on the back of a truck, and you're transporting it to a store to be sold, once it leaves 100 feet of the premises, it will not be covered by your property coverage anymore. Okay, we'll talk about that in a minute. Companies want you to carry at least 80% of coinsurance, because if you carry 80% coinsurance, that means if you have 80% of coverage of the value of the building, you get extensions for free. Now, the difference between extensions and endorsements is extensions are free, endorsements are additional charge. One of the free extensions, there's three that you need to know. Okay, it's in my playbook. The first one is if you have 80% of coverage of the value of the building, if you buy a new building, like a newly acquired or constructed property, we'll give you up to $250,000 for that new building that you just bought. How's that? Okay, so you know how when you buy a new car, you have some time to tell the insurance company and add the new car on? Well, how about if you bought a new building? Okay, you have some coverage until you tell the lender and your insurance company that you've added it. Okay, and you have $250,000 worth of coverage for that newly acquired or constructed building. You also have $100,000 worth of coverage for the property in the building. So $250,000 for the building and $100,000 for contents in the building that you just bought. All right. And if your executives have laptops that they take home or business personal property, one of the extensions also is we give you like $10,000 for business personal property away from the location of the business. Okay. So for a business personal property, off premises coverage. Okay. That's one of the extensions that you get as long as you have 80% of coverage to the value of the property. If you go insure for less than that, you're probably going to come up short on the claim. Okay. So again, insurance companies encourage you to carry reasonable amounts of coverage, so you don't come up short even in a partial loss. All right. So under a commercial property coverage form with no optional coverages, on what basis are buildings valued? And that's actual cash value. Now you notice I didn't read unendorsed under a commercial property policy. The buildings are valued on an actual cash value basis because unendorsed just means you don't have endorsements. So your commercial property policy covers buildings on an actual cash value basis. They throw in a lot of useless verbiage. It means nothing to the test, okay? But it throws people off because you're stressed. You know, you're hoping you pass, and you can't see straight. And these words confuse you sometimes, okay? So you got to break through that. And through repetition of the questions, you'll get a better understanding. And wherever you need clarification, reach out to me. Okay? One example of a loss covered by business income insurance is a loss of profits. So if you have a commercial building and your building burns down, well, you might want business income coverage. So let's say you're a restaurant. The restaurant burns down. Okay, well, you relied on income that the restaurant was bringing in to help you pay your bills, right? And so business income replaces that lost income that you would have normally earned if you were open for business, okay, because of a covered loss. For business income, there's a 72-hour deductible. That means if your restaurant has a fire and you're closed down and you can't open up and take care of customers, you have to wait 3 days, 72 hours, before we start paying you the lost business income to replace the income you normally would have earned if you were open for business. Okay, that's what business income is all about. If a property owner is insured under a building and personal property insurance form, when is the property considered vacant? Now, this is a tricky one. Oops, go back. All right. So if you own a building, as an insurance company, you have coverage on this building. We would consider your building vacant if 70% is empty. Another way of saying 70% empty is less than 31% is being used. Okay, so you have a 10-story building and 7 stories are empty. Okay, as an insurance company, we would say that's a vacant building. Okay, now being vacant for more than 60 days, you're not going to have coverage for vandalism, water damage, theft or attempted theft, glass breakage, and sprinkler leakage. Okay, so there's 5 perils that aren't covered if the property is left vacant for more than 60 days. Okay, now remember, this is a definition of vacancy if you're the owner of the building. Okay, well, how about if you're a tenant in a building? So you don't own the building, you're just leasing space in the building, all right, for your company. Well, then you have a different definition of vacancy. And that would be you don't have enough business personal property to conduct your business. And so it's a different definition than the person that owns a building. And so the test, I mean, just changing one word, right, property owner, or two words, to a tenant changes the answer. And so you need to know. So if you're renting like one floor of a 10-story building, and you're running a print shop operation, and out of this whole floor that you're leasing out, all you have is one multi-function fax copier scanner in the corner of this room. To an insurance company, that's not enough business personal property to run a print shop company. And so we would classify your business as being vacant and that's the tenant. Okay, so you're renting. Right? So know the difference between owner and tenant as far as the definition of vacancy. Okay. Thomas Fry has insured a building under his commercial policy. The building has been vacant for 75 consecutive days before loss. The policy will not pay for the loss if it is caused by glass breakage, vandalism, water damage, sprinkler leakage, theft or attempted theft are the 5 perils that we won't cover, because it's after 60 days. Anything after 60 days, we don't cover that. Now, all these other losses, riot, fire, windstorm, or hail, if you suffer loss from these after 60 days of being vacant, we still cover these, okay? But if it's not one of the 5 excluded perils, we're going to pay these claims for riot, fire, windstorm, or hail minus 15%. Okay, so after 60 days of being vacant, there's 5 perils we won't cover. Everything else we still cover minus 15%. It's kind of a penalty for leaving the property vacant. Okay. All right, so now we covered property. Let's talk about the other coverage. So remember dwelling, we had dwelling covers of property. That was a burrito. Theft and liability is the rice and beans. Okay. We talked about floaters, right? Covering your jewelry at higher limits, right? And we talked about auto insurance at the beginning of this webinar. Well, for a business, instead of calling it theft coverage, we're going to call it crime coverage. Because you think if you run a business, well, you need coverage for the building, but you also need coverage because someone could steal your stuff. Right? Just like a dwelling, you need liability in case you have a party and you have some guests and they slip and fall. Well, how about it for business? What if our clients slip and fall in our lobby? How about if our clients bought a product, they took it home and it malfunctioned and stabbed their kid in the leg 2 years later? That's a liability exposure that we need to make sure we protect. Otherwise, we get sued and we have to pay out of pocket. The floaters, to increase your coverage on your jewelry over here, well, for a business, it's called inland marine. Because what if you're a jewelry store, you want to increase coverage on the jewelry you sell, but you also have customers' jewelry under your care, custody, and control. How about if you're a fur coat, you sell fur coats, and you have customers' coats for cleaning in your store? Then you need inland marine coverage. It's not Bailey's coverage. Bailey's coverage is normal clothes. Fur coats are pretty expensive, and that would be inland marine. So inland marine covers mobile equipment like a forklift, a Zamboni. For those of you that are not familiar with a Zamboni, it's that machine that cleans the top sheet of ice at the ice rink. Probably goes about 2 to 3 miles an hour. It's inland marine is something that's not street legal. It means you're not going to drive a Zamboni down a freeway, because you sure as hell won't be moving very fast, okay? But that's inland marine coverage. Camera, musical instruments, things used on a theatrical set, okay, scenery and props, that's going to be here, all right? If you have a vehicle, that's commercial auto coverage. Just like your personal auto policy covers your personal car. For business, what if we have a fleet of cars that we give our executives? That would be covered by the commercial auto policy. Just like over here, you have liability in case you hit someone. For a business, we have liability in case our employee driving the company car hits someone also. The kicker here is medical and uninsured motorist is optional on the commercial policy. Medical and uninsured motorists are actually built into your personal auto policy. If your clients don't want medical or uninsured motorists, you want them to sign off that they're choosing not to take it. But for commercial, it's optional. All right? Here's the thing. If your employees are driving a company car, your employees are covered under workers' comp. So whether they get injured by this accident or someone without insurance hits them, if they're on the job, workers' comp covers the injury. So these are not really needed as long as it's only the employees are in the car. On the personal auto, we have physical damage coverage, which we have collision and other than collision coverage. For business, we have one extra option. So we have collision coverage in case you hit something and damage your car, We have comprehensive, which is something hits you. And for the test, comprehensive under commercial auto is the most, I guess, the most coverage you can get for a commercial auto policy. But if you're kind of a cheap business owner, you might want to just get the specified cause of loss. This is talking about really, really limited coverage. But you could mix and match it. How about collision and specified cause of loss? How about just comprehensive? How about just specified cause of loss? So you can mix and match it for a business. Okay. Another thing about commercial auto is we classify vehicles and coverages by using symbols. Okay, which we're going to get to in a minute. The home warranty over here, remember, covering appliances in your house, washer, dryer, machinery. We have boiler machinery for a business. Kind of the same coverage, just a different name. Steam pipes, steam turbines, things like that. Equipment breakdown coverage. Okay. So remember, theft coverage on the personal line side is called crime coverage for a business. There's 4 parts of the policy: employee dishonesty, forgery, alteration, theft of money, or theft of property. Make sure you know Section A covers employee dishonesty. One of your test questions says, which policy provides coverage for employee dishonesty? And honestly, I want you to look for fidelity bond first, but if you don't see it, then look for crime coverage covers employee dishonesty. You need to know the definition of theft, which is any act of stealing. Burglary is defined as the breaking into closed premises and the taking of someone's property. It's more of the breaking into closed premises, right? Damage to the property because you kicked in the door to break in, okay? And that's the definition of burglary. The breaking into closed premises as evidenced by visible marks of forcible entry. That's the definition you'll get for this. In robbery, so burglary, they broke into closed premises, there's no one around. Theft is any act of stealing. So let me explain. Burglary, they kicked in the door to steal your stuff. Theft, you left the door open, unlocked, and they just walked in and took your stuff. So there's no damage to the entryway or exitway. Robbery is someone is there and they're being threatened. We're threatening to injure or murder someone and take property from them. Safe burglary is someone has a safe, they broke into your safe and stole your stuff. Okay. All right. Some other definitions: you have messenger versus custodian. Custodian is not what you think, cleaning up offices after everyone's gone. Okay. Let's say I give my employee my bank deposit and they're in the building. They're a custodian because they have possession of company property on the premises. Okay. Messenger is, I gave my employee the deposit. They get in their car and they drive to the bank to make a deposit. Well, now they become a messenger because they have possession of company property away from the location of the business. Okay. And so this would be on-premises coverage, and this would be off-premises coverage. So again, you need to have both in order for totally to be covered. If you only had on-premises, then when your employee drives to the bank to make the deposit and something happens, it won't be covered. Okay. So again, educate your clients. Commercial general liability, or just general liability. So, like liability for a house in case you have a slip and fall at a party, right? Well, for a business, the same thing. There's a general aggregate limit, and it covers premises, which is the location of the business, like a slip and fall in the lobby. But there's a separate aggregate limit for products and completed operations. Okay. And so your commercial general liability policy has 2 separate aggregate limits. Most of your policies only have 1 aggregate limit. So let's define that. An aggregate limit is the maximum your policy will pay for all claims during a policy period. Okay. So let's say you have a homeowner's policy and you have a $100,000 liability limit. Now that $100,000 is per occurrence. Okay, that means you have a party and we'll pay up to $100,000 for injuries because maybe your guest got injured because the porch collapsed and injured them. Okay. Now the aggregate limit is the maximum we're going to pay for all your claims during that policy period that you had the homeowners. So if you had a $100,000 per occurrence limit, most of your personal lines coverages, your aggregate limit would be double that, so you have $200,000 total for the whole year. So once we paid more than $200,000 in claims for your homeowner's policy for liability, then you've exhausted your insurance. So if another claim comes in that you're responsible for because you injured someone else, you're paying out of pocket because you exhausted your insurance. So all of your policies really have one aggregate limit except for this commercial general liability policy. This actually has two, at least two, it actually has six, but two that you need to be aware of. Two separate aggregate limits, one for the location of the business and one for products and completed operations. That means they bought a toy from your toy company, they took it home, and 3 years later it injured a family member. Okay, so that loss occurred away from the location of the business. That's why there's a separate liability limit for that. Your commercial general liability covers liability associated with mobile equipment. So inland marine actually covers the forklift, but liability covers you drove the forklift through your neighbor's company wall. And so you injured or damaged someone else's property. That's the liability. Your commercial general liability doesn't cover professional liability. Commercial general liability covers the business. Professional liability covers the individual. Okay, the doctor makes a mistake during surgery. That's the individual. Okay. Your commercial general liability doesn't cover aircraft. That's aircraft coverage. Okay. Uh-oh, somebody's got an alarm. Oh. All right. So, and your commercial general liability doesn't cover you if you're in the alcohol business. Now, your commercial general liability policy will cover occasional liquor use by a company. So let's say you work for a company and they have a quarterly kickoff meeting and they serve alcohol. That's covered by your commercial general liability policy. But if you're actually in the alcohol business, manufacturing, distilling, serving, or transporting, there won't be any coverage. You'd have to get the liquor liability endorsement to cover that. Okay. But for the test, host liquor is covered. Host is occasional liquor use, but you're not in the business of alcohol. Okay. All right. Coverages A and or B of the commercial general liability contract contain coverage for, and it's advertising injury. Okay. So coverage A covers bodily injury and property damage to others. Coverage B covers personal and advertising injury. And coverage C is going to cover medical. Okay. So, I mean, you may get questions A or B, or you might get this. This is where one of the questions that flip-flops. All right. It may say, what part of your commercial general liability contract covers advertising injury? And you need to know that's part B. Okay. But you won't get part B as an answer by itself. It'll say like this, part A and or B. And that's the one you want to pick. Okay. So be wary of that. And I do have that. I think I've updated that in exam 6. Okay. Which of the following is listed on a commercial general liability declarations as an aggregate limit? And that's the products and completed operations limit. So remember, you have the premises and operations aggregate limit and the products and completed operations aggregate limit. They're two separate aggregate limits. All right. All right. Another way of saying that is the commercial general liability deck page displays many different limits of insurance that apply to a policy. One limit shown is the insured's general aggregate limit. Which of the following is a correct statement about the general aggregate limit? The general aggregate limit, that would be the premises and operations aggregate limit. And it B does not include the products and completed operations aggregate limit, because remember, this is a separate limit. Okay. See, there's so many ways of saying the same thing. Okay. And initially, you may not understand what the hell they're talking about, but by going through the questions repeatedly, you start picking up, and that picture gets painted where you have a better understanding. Okay. So it takes a little bit. And again, some of this stuff, let's say you only do personal lines, you'll never deal with this. But you need this information to pass the test. Okay. JAE Computer Company is being sued by Stack Computer Company for an advertising campaign that Stack Computer feels is false and misleading. JAE Computer Company would find coverage for losses which could result from this lawsuit under what category of insurance? And that would be your general liability. Remember, liability, you injure someone else. Okay. So, inland marine, just like a personal article floater, personal property floater to cover your personal jewelry at higher limits, we're just using this for a business. So there's different types of inland marine coverage. The first one, we'll use accounts receivable. Let's say you have a fire and you lose your accounts receivable file. That means you don't know who owes you money, how much they owe you, and when it's due to pay you. And so your inland marine coverage can actually cover the cost to reconstruct your accounts receivable file so that you can collect from the people that owe you money. Okay. Contractors equipment coverage covers, contractors equipment like bulldozers and equipment that's used on a job site. All right, so anytime you see equipment, think mobile equipment, which is non-street legal vehicles like a forklift, Zamboni, right? Equipment dealers coverage means we're actually selling bulldozers or Zambonis or forklifts, okay? Camera and musical instrument coverage. This covers you using cameras and musical instruments in the course of the business. Commercial articles dealer coverage. Anytime you see dealers, it means we're selling, and this is actually selling cameras and musical instruments. Jeweler's block covers, of course, jewelry. It also covers customers' jewelry under your care, custody, and control, right? Being cleaned, resized. Right? Theatrical property coverage, like I said, covers things used on the set, like scenery, prop, costume, jewelry, can also be covered by that. Okay, that's inland marine coverage. So where would an insured find insurance coverage to protect against damage to a shipment of televisions shipped on a semi-truck for the insured business? And that would be inland marine. Okay. Your commercial property policy, I said, covers your inventory if it's in and around the building within 100 feet of the building. Your commercial auto policy covers your auto. Commercial general liability covers what you damage, right, with your mobile equipment. But the mobile equipment being shipped or the product being shipped is covered by inland marine. It covers goods in transit, okay? Not just giving you higher limits, but it just covers goods in transit. Commercial auto coverage. So if you have a business, you have vehicles used in the course of the business, the easiest way to know what type of coverage you have on it is put a symbol next to it. I know it looks like numbers, right, but these are symbols. Okay, these are the most common ones. There's actually 60 some symbols. You only need to know these, and the most common one is symbol number 7, by the way. Okay, but let me explain how it's easy to remember these. Symbol 9 begins with the letter N. N for 9. N for non-owned autos. How's that? 7 begins with the letter S. S for 7. S for specifically described autos. F begins with 5. F for 5. F for states that have no fault, which is not California. This is an unusual question, but this popped up on the test. This could be one of those additional questions that don't count. They're just seeing how people do. Okay. 4 also begins with an F, but I joke around. I'm ebonically challenged. I don't say 4. I say faux. All right. So faux owned autos. Just kind of drag it out. Faux owned autos, other than private passenger autos. All right. It sounds kind of cheesy, but when you're taking the test, you'll remember that, and you'll probably laugh like I did. Okay. Symbol number 1 is the first number of the numeric system, and A is the first letter of the alphabet. So when you see symbol 1, think of the first number, think of A first letter, which, by the way, any auto symbol 1 is the most comprehensive symbol. If you are the owner of a company and you're rated with symbol number 1, it basically covers you using any car. All right. That means covers you using your car, the company car, you use your employee's car, you rent a car. All of them would be covered if you're symbol number 1. The only exception, of course, is if you stole someone else's car. We're not going to cover that. Okay. A business auto policy, some other definitions. In using this, I look at pizza delivery. It's probably the best way that I can explain this. All right. So Round Table Pizza, they have their own delivery trucks, and those are owned autos because they're owned by the business. Domino's, you actually have to use your own car to deliver pizza, and so that's employees using their own cars. That's a non-owned auto. Okay, so let's say the Round Table Pizza guy walks to work because they have trucks at work to deliver pizza, and when he gets to the truck broke down. So he can't deliver pizza, so now he has to rent a car. He has to rent a car to deliver pizza. That would be a hired auto. So you're renting a car to use in the business, okay? Now, if I have an executive and I give him a company car, that's an owned auto, but I let my executives use it. And then I send my executive out to, Tennessee for a convention for my company. And when my executive goes to Tennessee, they rent a car. Well, my commercial auto policy covers the car that I let them use. So if they go rent a car and it's not for business like a hired auto, it's for a convention, as because I love my executives, I can purchase drive other car coverage. So it covers my executive, going, to another state and renting a car for a convention, or even taking a vacation to Hawaii and renting a car. So I'm going to extend my commercial auto coverage to a rental car that my executives use. Okay. Not necessarily for business, because that would be hired auto. Now, if you're in the business, like a parking structure where there's valet parking, or if you have an auto repair shop and you drive customers' cars, you got to have garage keepers legal liability. This is the only type of coverage that covers you taking a customer's car for a drive on a test drive and you wrap it around a telephone pole, and that's a collision claim. Okay. So this covers customers' cars under your care when you take it for a test drive and there's a collision loss. Right? Boiler machinery, kind of touched on. Remember, this is like a home warranty, but for a business, sometimes called equipment breakdown coverage. It's written as all risk. All right. Anytime you see all risk, pay attention to exclusions. The biggest exclusion is wear and tear. But like I said, your test will call it an inherent defect. Tools have a tendency to wear out over a period of time and need to be replaced. That is an inherent defect. Okay, that's what that's about. When you pay premium for boiler machinery, most of your premium goes towards inspections. And those inspections are to prevent loss. And unlike your commercial property policy that pays actual cash value, boiler machinery pays replacement cost. So it covers explosion of steam pipes, steam turbines, generators, and things like that. Okay. Farm coverage. So even though you had a whole chapter on farm on your online pre-licensing required hour training, you're lucky to get 2 questions on farm. The first one is, it's a blend of residential and commercial on one plan. Because not only do you live on the farm, you also work there. All right. Just like our other policies, the companies want you to carry 80% of co-insurance, 80% of coverage of the value of the building. Your farm coverage covers farm equipment like the tractor, but it doesn't cover Farmer John's truck that he drives to the store to pick up groceries, because that's auto insurance. There can be farm liability, because there's liability associated with the farm. Okay. And livestock coverage. So how about if you had a suicidal cow that hit a car? Because remember, if an animal hits you, we always say the animal hit you, and it's a comp claim, right? So let's say suicidal Farmer John's cow hits your car, damages your car. Farmer John's responsible. So Farmer John's farm liability will cover the damage Farmer John's cow did to your car, all right? But let's say the cow actually committed suicide and actually died in that impact. Well, we need to replace the cow, and so that's the livestock coverage. Okay. Now, if you do have a crop, typically crop coverage is provided by the federal government. Okay. One of the test questions will ask you, like, which of the following is not a federal program? Federal crime, federal crop, national flood insurance program. Those are all federal. Workers' compensation is a state-run program. So that's the one that's not a federal or national program. So workers' comp is state-run. Make sure you understand that. Okay. Bonds. Okay. Bonds are not insurance. Bonds are financial guarantees. Keep that in mind. Insurance is a two-party contract between the first party, which is the insured, the client, and the second party, which is the insurance company or insurer. Well, bonds are three-party contracts. The first party to the bond is the obligee. All right. And this is a question you're going to get. A bond is designed to protect which of the following? The obligee. All right. In a bond, who is required to do something? And that's the principal. The principal has to do something. All right. All right. So let's start with a fidelity bond. So let's say you're an employer, you have a company, and you want to protect yourself in case your employee steals from you. Okay. So what happens in the real world, if you did not buy proper coverage, your employee steals from you, you're going to fire them. Then you're going to miss work and miss pay, because now you have to try and file suit against that employee to get your money back. Okay. And again, you miss work, you miss pay dealing with this. It's a pain in the rear. So go ahead and buy a fidelity bond. So now if your employee steals from you, We, the insurance company, the guarantor, we're going to pay you what your employee stole from you, so you go on about your business. And then we, the insurance company guarantor, we are the ones that are going to go after the dishonest employee to recover what we paid you. So if your employees steal, rather than you going after the employee, we, the insurance company, pay you, you go on about your life, and we deal with it. Okay? That's basically a subrogation contract. Subrogation means transferring your claim rights to a third party. Okay? A one-word definition for subrogation is called substitution. Right? Now, that's a fidelity bond, and with a fidelity bond, the employer actually pays a premium to protect themselves. A surety bond is still a three-party contract, but it's going to be slightly different. So let's say you're a homeowner, and you're going to contract a contractor to build a redwood deck in your backyard before Thanksgiving, where you're having a big Thanksgiving dinner with your family. Okay, and so you're telling the contractor, look, I need this redwood deck built by Thanksgiving for my party. The contractor says, I promise you I will complete the work on time. And you say, well, hey, contractor, how can you guarantee the work? The contractor says, I will pay for a surety bond. Okay, so now the contractor pays a premium on a bond to protect you, the homeowner. So if the contractor completes the deck on time, that's great. If the contractor doesn't complete building that redwood deck in time for Thanksgiving, we, the insurance company, give you the money to hire someone else to complete the work, and then we, the insurance company, are going to go after the contractor because they did not complete the work. They did not fulfill their obligation. There should never be a loss to bonds, because whatever we, the insurance company, pay you, we're going to collect from the people that did not fulfill their obligation. Okay, so always remember, bonds are there to protect the obligee, and the principal is the entity or person that has to do something, like not steal or build a redwood deck on time. Okay, that's how you need to know bonds. Commercial general liability versus commercial crime. There's two ways of writing liability. There's two ways of writing crime. Okay. Now, if you get this chart down, which is also one of my additional information on my website, you're going to get questions, and these four bold items: occurrence made, claims made, loss sustained, and discovery form, these are going to be your answers on that test question. So anytime you see liability, bodily injury, property damage, that's liability. So it means if these four are your answers, and you see bodily injury, liability, or property damage, your answer is between occurrence made and claims made, because that's how we write liability. You can eliminate these two answers. So you take out 50% of the answers. Now you just flip a coin for these, I guess, right? Okay. So if you see crime, theft, burglary in the question, well, now your answer is between loss sustained or discovery form, because that's how we write crime coverage. You can eliminate these two as an answer. Okay. Another step is if you see retroactive date or extended reporting periods, now your answer is between claims made and discovery form, because these ones have retroactive dates and extended reporting periods. That means you can eliminate these two. Now, there is one question. It doesn't say anything. It just says you have up to 1 year to file a claim. And when you see up to 1 year to file a claim, that's loss sustained. Okay. Now, the retroactive date, by the way, is when you buy this type of policy, you're going to pick a date, let's say 8 years ago. All right. So November 9th of 2009. Is that 8 years ago? Yeah, 2009. That means this policy that you're buying today covers you from November 8th of 2009 to today, plus the next year. Okay? So if anything happened before November 8th of 2009, we're not going to cover, because it happened before the retroactive date. So we can cover stuff that happened before you bought this policy, as long as it was uncertain or unknown. Remember, certain losses are not going to be covered by insurance. Extended reporting period means after the policy ends, you have additional time to file a claim and have the policy still pay for it. So always remember, extended reporting periods are not extending the time of coverage. It's just extending the time that you can still file a claim and have that policy cover it. Okay, so watch those questions carefully. All right? You can purchase a supplemental extended reporting period, which makes the claims reporting period an unlimited period of time. Okay. It's treated as a separate policy. It's additional charge, but again, makes the claims reporting period an unlimited period of time. Doesn't extend coverage unlimited. It just increases the time for someone to file a claim and have your policy cover it. Okay. So the retroactive date of a claims made professional liability policy is always the earliest date that we're going to cover a loss. Okay. If an insured discovers an occurrence 75 days after the expiration of a claims-made commercial liability policy, what must the insured have in order for the loss to be covered? And that's the supplemental extended reporting period. Okay, so let me go back to this. Under claims made, if someone suffers a loss, they have up to 60 days to file the claim. If they file the claim after the 60 days and they want coverage, well, hopefully this is in effect. Otherwise, that policy won't cover it. Okay, so if you discover an occurrence 75 days after the expiration of a policy, well, it's more than 60 days. You need to have this in effect. Otherwise, we're not going to cover the loss. Okay. In a claims-made general liability policy, how long do you have to report a claim which occurred during the policy period? This kind of reinforces after the coverage ends, you have still up to 60 days to still file a claim and have that policy covered. And notice I really didn't say unendorsed. Okay, remember, this is a useless word. A claims-made policy is a claims-made policy. Okay. And so this kind of ends our webinar. I mean, I covered quite a bit here, but yeah, I just want to make sure everyone's unmuted. If you haven't registered, I think pretty much everyone here is registered for my sample test questions. If not, contact me. But I want to open up for questions. Any areas where you need a little more information or you need clarification? All right, let's break it open here.
No.
No? Florette, Karina, Narita?
No, we're good.
Good?
Yes.
Pretty thorough? Again,
Yeah.
if you have any questions or anything, I mean, just reach out to me. This is my cell phone number. I'm not a 9 to 5 guy. If you're studying on the evenings and weekends, then give me a call or you can email me, all right, with your questions and I can reply. One of the things I'm going to do on my website is hopefully I'll have a room where I can set up a blog where people can just go there and pitch questions and I'll answer them. Okay, and give you explanations so everyone has that information. Okay, I'm going to be recording this. I have recorded this. In fact, let me